live in 2 places on YouTube. Oh, there we go. We're online. Cool. Online on Facebook and we're online on YouTube multiple times, it looks like. Interesting. Hey, everyone. Thanks for joining us on this wonderful evening. What are you drinking tonight? Taxes and bourbon. So
same thing I'm drinking. I still got to kill this. I don't want to keep mentioning it. I got to kill the
fake
what's
bourbon.
it called? The Maker's Mark first before I move on.
The bourbon that's not bourbon, whiskey bourbon. So I'm ashamed. I'm drinking this rosé champagne because I ran out of bourbon. Unlike you, I drink my bourbon. No, my dad came over this past weekend and we drank some bourbon together. So always good. Finished off my Four Roses single barrel. So if you have suggestions on what bottle I should go buy for next week's to start me off next week, let me know in the comments. I'd appreciate that. I'm always open to trying new bourbon. So yeah. And you're still drinking your mate. How much more of that do you have?
I probably have a few more weeks left of that at this pace. Probably like a little bit more than probably about a third of the bottle, if I had to estimate.
Yeah. Okay. Well, that'll take a little more time, but man, we are. I feel good now, man. I feel we're a whole week past the tax deadline, so I'm like things are starting to like click again. You know, things are starting to like kind of come back into focus. The growth picture's there. The bigger picture thinking's there. We're doing a lot of fun stuff now. Actually, for everybody watching, we are going to be hiring 8 people. So we're like growing our team by what is that? 30%, 20%, 25%. So if you know of any tax accountants that want a better life, send them our way. You paid a little bit more. We pay top of market. So we do pay top of market. I'm proud of that. This year was a little rough. You know, I think that if anybody that if you talk to any of our employees this year, they'd be like, hey, I don't know if it's like this whole paradise, but we're working on it. And we're making this huge step of growing our team relatively rapidly. What is it? 247? Oh no, that's like 40%. That's 40. Yeah, that's a lot.
I did it. Yeah, it was like, and it was like 8 divided by 20, and it got 40%. Yeah, so
yeah, that's 40. That's 40%. So we're growing our team by 8 people. We need a tax supervisor, which is kind of like a go between a tax senior and a tax manager, somebody that does like second level reviews on tax returns, but doesn't necessarily talk to clients a whole bunch. We need tax supervisor. We need a handful, like I think 3 tax seniors. We're looking for 3 tax associates. We're looking for a tax advisor and an accountant for our CFO world. That's kind of blowing up. We're getting a bunch of funds and syndicates coming in that need accounting services. So we're growing that team out too. But yeah, man, it feels real. Feels good too. You know, I'm excited for it.
I'm excited too.
We do more of this. Allows us to do more of this. That's really what it is. So if you want to see more of us on Facebook Lives or engaging the community, send us tax accountants that, like I said, want a better life. For real though, we have virtual, totally remote workforce, unlimited vacation, unlimited sick days. We're pretty chill. As long as you get your work done, produce at a high level, pretty chill from a management perspective.
Yeah, and if there's any CPAs actually listening to this right now, as I know sometimes some CPAs do hop on some of these Facebook Lives and whatnot and do stream this, you can contact us at contact@therealestatecpa.com or send us over your resume and we'll be in touch.
Yeah, 1,000%. All right. Well, I don't really have like a topic today. I guess I'll give everybody a quick update on legislation, and then what we can do is we can hit some of the questions that were in so I posted in the TaxSmart Facebook group. If you're watching on YouTube, go join us on the Facebook group. You can find it at facebook.com/groups/TaxSmartInvestors. But I posted in there earlier today, and there's some questions that came in, so I appreciate that. We'll hit those. But a quick update on legislation. So the Biden tax plan is apparently almost done. Like Actually, kind of surprised we haven't seen the framework yet, but we're expecting to see the framework sometime this week. So we'll have a pretty decent idea of what's in that tax proposal. And the big news is the billionaire tax. That I don't know if you guys have seen the headlines, but to get Sinema and Manchin, the two Democratic senators or congressman and woman that were the holdouts, because every Democrat congressman or woman has veto power right now because they have enough of a majority, but every single person has to vote yay in order to pass their spending bill. So there were two holdouts, and apparently to get the two holdouts across the finish line, there was a billionaire tax that was added, and they reduced the total spend from like 3.5 trillion to 1.7 trillion, 1.75 trillion. So, not that much money by any means. And I think that's over 10 years or something. But
yeah, to draw a comparison, the bailout bill in 2008 was like I think 700 billion. So I mean, this is like, just to put things in comparison of how increasing, how rapidly these bills have increased in the amount of money they want to just print, pretty much, or tax us to get.
Yeah. And the interesting thing on the billionaire tax too, and I was kind of thinking about it today. Like if they do a billionaire tax, it's not. It'll be fine while everything's going up, right? So the billionaire tax is a tax on your unrealized stock gains. So one of the things that billionaires do, or extremely rich people do, is they start companies, right? And they're C corporations. They take them public, and their stock price increases, so their net worth increases. But what they'll do is, instead of liquidating the stock and creating a tax event, they just get a loan against the stock value. So if I've got $100 million in stock, but I've got $0 in my bank account, I can't go buy anything, right? So I'll get like a $10 million loan against the stock value. And there are banks that will do that. So they'll just give me 10 million bucks. And since it's a loan, it's not a tax event, right? It's just like if you were to go and refinance a rental property. A cash out refinance is not a tax event because you still own the rental. You didn't sell it. So that's what billionaires are doing. And so they just basically never pay tax on the wealth accumulation. And, you could say, oh, that's not fair. But, it doesn't matter if it's fair or not. That's our system. And that's the system that we've had for, centuries, or whenever it was started. I actually don't know when it was started. When was the tax code started? Do you know?
I don't know offhand.
I don't know either. It's way before our time. But
well, tax has been around forever. The first ancient text in ancient Babylonia, the first civilization, was tax documents, the oldest documents that people found.
Yeah.
That's why I always say two things are guaranteed in life: death and taxes.
I've always thought being an anthropologist would be a really cool job. Those are the guys that go through and study that type of stuff, right? They study debt and capital market. I don't know. I don't know what an anthropologist does.
I'm pretty sure anthropologists study ancient sites and stuff. They dig up stuff.
Yeah. Well, whatever. Anyway, so billionaires. Back to billionaires. They buy the yachts with loans, right? So they never actually cash out their stock. So the Democrats have taken issue with that. They think that's a problem, and so what they're proposing is I think it's a 20% tax on the unrealized gain. So and it's above certain thresholds, which I don't know what the thresholds are. Excuse me. This carbonated rosé is not like drinking bourbon. It's not. I'm not getting the fire feeling, in my chest. So just getting gas. That's nice, huh? For a Facebook Live. Anyway, so this billionaire tax. So they're expecting to raise, I think it's like $200 billion by taxing the top 1,000 richest people in America, and it's just a tax on unrealized receivable or unrealized gains from your stock. But my problem is my problem with it is that's great in an up market when everything's going up, right? Because hey, if your stock just went from $10 million to $20 million, then we're going to tax you on the gain, the increase of 10 million bucks. 20%, so you owe us $2 million in taxes. Cool. Like, we're taxing wealth, which is different than our system, but logically, okay, I can make the numbers work. I understand that. What I don't understand is what happens in a down market. What happens when you go from $10 million to $5 million in value? Because everywhere else in the code, if you get taxed on the upswing, you also get a refund on the downswing. So my thought, and then I started looking this up, and apparently people way smarter than me had already way thought about this. But my thought was, wait a second. So in up markets, this is great, but in down markets, the IRS is going to be, or the government's going to subsidize billionaires by giving them a tax break, even though they don't liquidate their stock, because they're going to go down in value and they're going to get a refund. Essentially, I'm sure it's not actually going to work out like that, but there were a lot of discussions about that online that I found yesterday and today when I was kind of looking into this a little bit. So it's kind of interesting to think about, like it could backfire. Basically, the whole idea of this billionaire tax could backfire in a down market where, now you have to give refunds to the billionaires.
Well, the money's got to come from somewhere. That's what they think. So
yeah,
not the billionaires.
And it was kind of interesting too, because I was thinking about like why do people that don't have why do people who are not billionaires care? Because I've seen some Facebook posts like, oh, people that aren't billionaires and will never be one, you guys shouldn't care. It's amazing how much you guys. But I was thinking about it and I was like, you know what though? It's really the principle.
Yeah,
right?
Exactly. It's not
really what it is. It's really the principle. It's just the mere fact that okay, I'm a business owner, right? And I could have high aspirations, and then it's like, well, do I want to have that high of I mean, I don't think in my lifetime I'll ever be a billionaire. So, but still, it's kind of the principle of, I don't know, just getting to this point of success that you get taxed. You almost pay a penalty is really what it is for me. That's what it feels like. You get to a certain level of success and you got to pay a penalty. And some of the real estate investors out there too. I mean, we don't know what's in that final bill yet, but it could be kind of the same thing. You buy rental real estate, that's success, right? You've somehow saved up $50,000 for a down payment to go buy a rental property, and if they start stripping away the tax benefits, now all of a sudden it's an asset class that can't compete with the other asset classes that you could invest in from an ROI perspective, and it's just kind of like a penalty on the success. So that's what it kind of was. I had that realization yesterday, because I was kind of thinking this through the same sort of conversations. Like, why would I care? Why do I care? It's like, oh, it's really the principle. And I guess the other side of it too is like, when does it stop? How low do you go? It's a billionaire today, but could be 100 millionaire next year. It could be I don't know.
Yeah, I mean, because it just keeps getting worse and worse. The bottom line is they keep adding more and more taxes and more ways to get you. It's just and taking more and more stuff away, more and more tax breaks. That is, at some point, it's at what point are they just going to be taxing you through the nose? I mean, look, if you're already a high income earner in a state like New York or a state like California, it's not uncommon for you to be paying over 50% in taxes on your ordinary income. So, I mean.
Yeah,
I guess my point is they keep coming for your money.
yeah. Though, I would hate to be a politician. I mean, if you've the only way that I could ever see being a politician is if I've run a successful business and we got a lot of work to do before I'd feel like, yeah, we're successful. Don't get me wrong, we've accomplished great things, but we got a lot of work to do. But the only way that I would ever do that is if I ran a successful business and just wanted to complete change, and then I was just bored out of my mind and wanted to go and be a politician. I don't know, man. I don't know how politicians do it. I mean, as a business owner, if I want something done, I just go get it done. This is my idea. I want to do it this way. We're going to test it. Go. And in politics, you got to have a lot more swag, right? A lot more sway is the word I'm looking for.
You got to persuade a lot of people to your side. You can't.
That's a hard job, man. That's a hard job on either side of the party. That's a hard job. I don't envy them. That's for sure. But all right, well, enough of the updates. We kind of like veered a little bit into dangerous territory, but I think we did okay.
Yeah,
I
well,
think we did.
I got it. So since you mentioned this billionaire tax, I wasn't aware of it until you just mentioned it. I
Oh
haven't
man,
I haven't
Tom's
been
like
paying.
right now, man. He's like, "What billionaire tax? You freaking kidding me?"
You know what? I'm just trying to find, and I don't know if they released it yet. At what point does this phase? At what point of income or net worth or investment basis or however or fair market value of your investments does this get triggered? Right? Like, is it
I
is
don't know.
it if you're net worth it, or if you're valued at 500 million or $1 billion, now all of a sudden you're going to have this trigger, or is it going to be on capital gains for the everyday person at some level?
Yeah, I don't know,
Which is
man.
what I'm concerned about.
Well, I think we are going to know this week, so we'll be able to answer that. But yeah, I wish there was no taxes. We have a really good tax system right now for real estate investors. You know,
Yeah, the Tax Cuts and
don't
Jobs
change
Act
it.
was good. It was good. It was good to
Yeah, it was great
investors.
for real estate investors and businesses. Yeah, you don't change it. I guess we got to go into politics.
Just got to start lobbying Congress.
One day. All right, let's get to some of these Facebook questions. So, our first one is, I'm gonna mispronounce your name. I'm so sorry. The first one is Metodi. Maybe I didn't. Maybe I nailed that one actually. Metodi. Everyone in this group is talking about cost segregation. However, doing it yourself is kind of a big red flag for the IRS and an invitation for an audit. If done by a third party, qualified third party, then my CPA is telling me it's great, but due to the costs involved, it's usually best done for properties above $1 million. What's your opinion on this, Tom?
Okay, so my opinion is, I agree doing it yourself can be dangerous unless you're a qualified like engineer, and even that still might be a little bit of a red flag. But if you're doing it with a qualified third party, you should generally be in the clear. Now, as for properties above 1 million, typically traditional cost segregation studies, and to clarify what I mean by traditional, is when an engineer actually travels from wherever their office location is to your property and does their survey, and then comes up with a report. That usually is expensive and it's not going to make sense on properties below $1 million. But recently, in recent years, there's something called software cost segregation studies, or desktop studies, they're sometimes called, where basically some of these cost segregation companies have came up with a software where you can put the information about your property into the software, and it will generate a cost segregation study report based on their proprietary algorithms and national databases of information. And they can give you a cost segregation study report, and they have audit support that will often, if you purchase the audit support, they will fly down to your property in the event of an audit and actually do the cost segregation study if the software study does not hold up in the audit. So I guess the bottom line is, what's my opinion on it? Is that you should use a qualified third party to do it. You should not do it yourself in most cases, and that it is possible to do one under $1 million thanks to these software cost segregation studies, but with the caveat that they've not been audit tested, and that if you do end up going and doing that, you should be purchasing the audit support, because if you are ever audited, your backstop could be that the company will actually come down and do the do the actual cost segregation study on your behalf.
Yeah. Yeah, and it's important to point out too that these software cost seg studies, to my knowledge, have not been tax court tested. So proceed with caution. If you are a person that doesn't sleep well at night with risk, then don't get a software cost seg study done. Go the actual route. I actually see Yona Weiss is in the house, so you can go and ask Yona all of your cost segregation questions as well. He is the cost seg king. I believe that's what you're going by now, Yona, on pretty much every social media platform. Metodi, I think I just said it right again. You said you nailed it, so that makes me really happy. You know, when I used to run all the sales for our business before Tom stepped up and into that spot, and before we hired Lou, our current client success manager. Before those guys really helped me out, I would get all sorts of interesting like names coming through our web forums, and so I would go online. There was there was this tool online that you could type in somebody's name and it would say it back to you. Like it would pronounce it for you. So I would always like do that before jumping onto the sales call with anybody that I was about to talk with, because then I would say, hi, so and so, and I would nail the pronunciation of it, and they'd be like, wow, nobody like ever says it right the first time. So just always got a little some bonus points right at the beginning there. Just a little tip for anybody that's in sales. But anyway, all right. Peter asks, what are the tax implications of crypto lending, earning interest versus crypto staking? Tom, do you know?
I do not know. I'm not the advanced crypto staking guy at this point. I don't fully understand staking at this moment, so I can't respond to that.
Although you were just talking about how we need an NFT for the real estate CPA.
Oh yeah, one of the guys we work with, one of our marketing consultants, I guess you could say, basically told me that we should start an NFT because we could have a tax smart investor NFT, for example, and everybody within the group could have a coin that represents their membership in the group, and the coin can be traded. I'm not 100% sure how that would work or how you set one of those up, but it seems to be the motion. I mean, every day crypto's making headlines. Every day, people in this group are asking questions, clients are asking questions, and the crypto doesn't seem to be going anywhere, man. The one thing that
apparently NFTs is the future. I listened to a lot of Gary Vaynerchuk, and he's not everybody's cup of tea, but I love listening to him. But he's all about the NFT space, so yeah, there might be something there.
Yeah, I mean, at this point, I just don't understand. Like, if you have a digital piece of artwork, which is what my current level of understanding of NFT is, like, what does that do for you? like, what's the utility of that electronic piece of artwork? An 8-bit piece of artwork. They have 8-bit artwork since NES, Nintendo, back in like the 80s. So I don't get it. I have to look into it.
Well, you know what though? Wasn't that Warren Buffett's argument with tech stocks back in the day? And now he's like regretful of it. So I don't know, man. You gotta.
Yeah, but I mean, at least a tech stock, right? You're buying into a company. There's a company behind it. Like these, I'm gonna hold my tongue at the risk.
But I mean, they operated at losses for years and years and years. That was the whole thing, right?
So. That too.
All right. We'll have to look into that. Peter, sorry, we don't. I don't know that we have an answer for you. I would imagine though that it is probably relatively similar to lending anything else.
Yeah, I think on the lending side, if you own a piece of cryptocurrency, you put it on one of those platforms that can pay you like an 8% interest rate on your crypto, that's probably going to be taxed as interest. But the crypto staking is the part that I'm not sure of.
Yeah. All right. Using IDGT to save on taxes. This is a question from Steve. Turn active income into passive income using IDGT.
So IDGT's
take advantage of depreciation, offset passive income.
So an IDT is an intentionally defective grantor trust.
Oh, got it.
So intentionally defective grantor trust, from my understanding, allows you to basically have like an irrevocable trust, transfer the assets to the trust, but still have it taxed to you. So I don't know how that interplays with turning active income into passive income using the IDGT. So we have to look into that.
I don't think it does. I mean, trusts are still subject to Section 469. There are always groups of people out there that are trying to tell you about the next awesome trust structure, and they make you sign an NDA before you're allowed to see the structure, and it's just like, okay, you can't, like, I just don't believe it. So, I mean, they're all subject to Section 469. Either you materially participate or you don't. A trust can be a real estate professional. So, I mean, that was a tax court case where there was a ruling where a trust did qualify as a real estate professional. So, I think that it's substance over form. So, regardless of what form you have, form being like entity structure, trust structure, it's not going to matter at the end of the day. It's still going to be passive income or not passive income based on Section 469. And I'm not obviously super familiar with intentionally defective grantor trusts. I just know that I've seen a lot of trust structures. I've seen a lot of people naming trusts a lot of different things, trying to get around these rules, and a lot of times it's just a kind of too good to be true sort of situation. So
yeah, what I'll say about trusts and a lot of things is sometimes a lot of this stuff sounds really sexy, but it's really either unnecessary or so complicated to the point that you really have to question their validity, because some attorneys will even tell you that the trusts have not been tested in like the court of law and all of this stuff, and that it's effectively like a strategy that a bunch of attorneys came up with that they're hoping will fly if it's ever tested.
Yeah. Steve just commented, said IDGT involves your heirs to help make active income passive. I would have to see what's being proposed to like really give you a solid understanding of what's going on. I did also see that you said it's confusing to you. Yeah. I mean, look, guys, if it's confusing, and it like a lot of tax strategies can be summarized pretty eloquently without, I mean, if somebody's got to like really go into it with you, it's probably, you should just press pause. So
yeah, if they look at the guy from what's that show called, the guy where he's like Pepe Sylvia, and he has all the stuff on the thing, he's like trying to explain it to you. You know what I'm saying? If it looks like that, it's probably bad.
Yeah, exactly. All right, let's see. Daniela asked, what are the potential downsides to investing in an out-of-state property while being a California resident? What do you think, Tom?
You say that again?
What are the downsides to investing in an out-of-state property if you're a California resident?
Yeah, so the downsides of investing in a California property as an out-of-state property is kind of two things that come to mind. First of all, if you're going to use an LLC in another state, somehow, some way, California always tries to claim that you're doing business in their state simply because you're sitting in their state, because that's where your residency is. So that's one potential issue, because a lot of people like to use LLCs. The second issue is,
can we actually expand on that a little bit? Because I think there's a lot of people. I saw something the other day in a different group where somebody was like, "Oh yeah, I got my attorney said, don't worry, just go set up all these out of state LLCs, you'll be fine." The problem is that if you live in California and you're making phone calls from California, they're going to deem you to be in business in California, like the California Secretary of State will, or franchise board will, and they'll come after you for it. So that if you have out of state LLCs, then California, like, just expect them to come after you. Now, whether or not they find you and whether or not they recognize you have out of state LLCs, that can depend on structure. But the reality is that if they do find you and they do find out that you have out of state LLCs, they will make you register and they will make you pay back taxes. They will make you pay that $800 tax. So just be aware of that. Like, again, like you decide what level of risk you want to take. We're just really big on, no BS tax advice. So
yeah. Someone just commented, franchise tax board in NCA is ruthless. I've heard they're more ruthless than the IRS. Like, they'll come and knock on your door in California. That's what I've heard. I don't live in California. I live across the country, but that's what I've heard.
Yeah,
and I don't doubt it. I was gonna say,
I believe it, man. I believe it. All right, I got one more from Karthik, so we'll do one more. Karthik's actually commenting on our YouTube live, which is awesome. We have 6 people watching on our YouTube live. We have 2 live streams on YouTube right now. I don't know why that is. We're gonna have to look into that. But thank you for joining us on YouTube, guys. And if you are on YouTube, go join our TaxSmart Facebook group. It's facebook.com/groups/TaxSmartInvestors. We'd love to have you as part of our larger community, or if you're just watching on YouTube live because that's what you prefer to watch, that's cool too. So Karthik says, great show. Quick question. I'm on. Thank you, Karthik. I appreciate that. We never really know, we're like talking bourbon, talking some politics, just kind of like, riffing, but I feel like it's a good Tuesday night fireside chat. All right, I'm on W2 making a little over 150K. My wife stays at home, spouse stays at home. I have 3 rentals Any suggestions on reducing my taxes? Any ways to write off active income? So makes over 150K, has 3 rentals, spouse stays at home. What should Karthik do?
Karthik, you should convince your wife to become a real estate professional by playing an active role in the management of the 3 properties you own. So you can go ahead and run cost segregation studies on those properties. I'm this, by the way, consult your tax professional before taking this, because there's some looking under the hood that needs to take place before you actually go and execute what I'm saying. But you could basically, if your wife can qualify as a real estate professional, she can take the losses from your rental properties will be non-passive, and they could offset your W-2 income, right? So if your wife can qualify as that, you potentially run cost segregation studies, increase your depreciation expense thanks to bonus depreciation, right? And you can reduce your tax liability, increasing the amount of essentially cash that you have, because you're not paying the government that some taxes that you would otherwise be paying them, and then you can have more money to invest. So that is something that maybe you may want to consider.
Yeah. Another thing, Karthik, is I don't know if you can like contribute more. I guess it's on AGI, right? The $25,000 loss allowance. Is that on modified? That's on modified just gross income. Never mind.
Yeah, it's unmodified. Yeah.
Yeah. So Karthik, you could also contribute more to your 401k, and the more that you contribute to your 401k, if it drops down, if your AG modified adjusted gross income drops below $150,000, you could. Sorry, I'm like doing a little test while I'm trying to talk right now. Sorry, guys. You could get some of that $25,000 passive loss allowance. So if you earn less than $150,000 modified adjusted gross income, you can claim up to a $25,000 passive loss allowance as long as you own at least 10% of the activity, the rental activity, and you make management decisions, which is basically just like overseeing a property manager. That's kind of what that is. So if you make less than 100, you get the full $25,000 allowance, which is great because you don't have to qualify as a real estate professional. You just have to own rental property and earn less than 100K. Then you can claim up to $25,000 in passive losses from your rentals. But it gets phased out over time. Not over time, but it gets phased out as your income increases. And once you hit 150K, it's totally phased out. So if you could drop your income by making a 401k contribution to like 140K, then you'd have a $10,000 spread between 150 and 140. And that $10,000 spread would allow you to write off $5,000 in losses. So you could look at something like that. I don't know if that's possible. Most of our clients that are in like the 160K range, it's actually a lot harder to do than. Yeah. So probably go Tom's route, do the real estate professional status.
Yeah, I mean, it really just depends on what your strategy is overall. If you want to accumulate as much cash as you can to invest in real estate, right, then you're going to want to go the reps route. If you like to have some of your assets spread around, you like diversifying your assets. I personally diversify assets. You might want to have money in the 401k, and Brennan's route may be the better route. So it kind of just depends on your overall investment goals, and how you want to look at your overall portfolio and which route would make the most sense for you.
Yeah. Karthik says, "Thank you. That helps a lot." That's cool, man. You can display people's chat. You're welcome, Karthik.
Restream continues to impress me every week so far. We did 2 weeks in a row, so we'll see what happens next week.
So I posted for our Facebook group. So on Restream, we're using Restream. That's an interface on the back end that like you record one video, and we are live right now, but you record one video and then it pushes out to Facebook and YouTube and Instagram and all this other stuff. But when all of our Facebook users are when everybody in our Facebook group is chatting on the live stream, it just shows up as Facebook user. Whenever somebody's posting from like YouTube, it actually shows your name. So in our Facebook live stream, I just posted a link. It's like chatrestream.io. And if you click it, it'll say like allow Restream to connect to my Facebook. I think that all that does is it just allows you, whenever you comment on our live stream, it like on our dashboard here, instead of showing up as Facebook user, it'll actually show your display name. Can somebody try that for me real quick? If you don't mind, just like try connecting that and then make a comment real quick. I just want to see if that works, because if it does, we'll just start there next time. Because it would be great if we could see that and we could display like this is what it looks like on our end, right? Facebook user, can someone try this for me? This is me posting in our live stream, but that's what it looks like on our end. versus Karthik's comment from YouTube. You can see his name, so it would just help us a lot if that could actually happen. And while somebody is testing that, because I know somebody's going to test that for us, Justin asks, he's buying a property in Florida, my primary residence being in Texas. Do I need to, it takes you to a login page. Man, wait, let's see. No, yeah, it doesn't work. It takes you to a login page. I'm sorry. Okay, I'll figure that out. We'll keep playing around with that. Thank you for the test. I appreciate it. I'm back to Karthik. Here, I gotta share this one. This is good. Give Eagle Rare bourbon a try if you can find it. I've had Eagle Rare before. It's very good. I will try to find that for next week. Thank you, Karthik, for the recommendation. Contributing to my bad habits. All right, Justin, you asked, should I create an LLC in Texas if I live in Texas, but I'm buying a property in Florida? From a tax perspective, you don't need to. From a legal perspective, you might want to, but no real reason that I'm aware of from a tax perspective. But I would definitely ask an attorney that question. And then we've got, did I have one more? Yeah, we do have one more. Sat Paul, you asked, does an OZ investment deal give you the tax-free benefit if held for 10 years, irrespective of if I had a capital gain or not in 2021?
I could break it down real quick, right?
Yeah,
all right. So qualified opportunity zones, right? You have a capital gain today. Let's say you have a $10,000 capital gain today. You put it in the opportunity zone fund. You hold it for 5 years, which is still possible if you invest the gain in the opportunity fund before the end of this year. So that means before 12/31 or on 12/31 of this year. Then in 5 years, you can get a stepped up basis on that gain, right? So of 10%. So just kind of just paint the picture. What that means is you're going to have to pay tax on, I believe, $9,000 if I did the math right. Sorry, taxes in bourbon. Haven't got my math skills a little bit down right now. But you're going to pay tax on 90% of that capital gain in 2026 at the capital gains rate that's in place in 2026. If you hold that investment, that $10,000 investment in this example, for 10 years, then the gain on that $10,000 investment is going to be exempt from taxes. So, for example, let's say that $10,000 investment in 10 years accumulated to $50,000. Well, guess what? That $40,000 capital gain will be exempt from taxes in most cases. So that's kind of how it works in a nutshell. Hopefully that answers your question.
Cool. And I did just test the Restream, and it does work. There you go. See? So we'll have to start there next time. But all right. Thank you all for coming. We appreciate it. Another Taxes and Bourbon wrapped up. Thank you so much. We will be back here again next Tuesday, 7:30 p.m. Eastern. I'll be drinking, hopefully, Eagle Rare. Tom will be finishing off his makers.
Unless Halloween gets crazy, I mean, I'll be finishing off the makers.
That's true. Yeah. Have a good Halloween. If you have kids, take cool pictures. My son is going to be a trash truck. I don't know if anybody has kids, but there's a trash. There's a show on Netflix called Trash Truck that he is in love with. Man, every time the trash truck goes by, gets our trash, he's like at the window screaming "trash truck." So very into it. So he's gonna be a trash truck, and I think I'm gonna be like garbage. That's what my wife told me to be. Garbage. I'm just kidding. My wife's not that. No, she's very loving, very, very loving, very caring. But she did kind of tell me in not so many words to be garbage. So
well, hey.
Anything for the kids, right? Anything for the kids. All right. Well, have a safe Halloween, everyone. We will see you back here at 7:30 p.m. Eastern on Tuesday. Bring a friend, like bring some folks to it. We want to help spread the tax wisdom and have a little bit of fun doing it. So thank you all so much. Have a great night.